Good evening, everyone. I hope my screen is visible now. It's been a system reboot and hence I had to restart the system all over again. Okay, so today we will take up India's 21, which is about foreign exchange. Basically, the standard talks about how to deal with the changes in foreign exchange rates. That is the entire title of the standard. We'll be focusing on, how do we translate foreign currency financial statements, how do we record foreign currency transactions, and how do we account for the exchange differences. Now, one very important aspect here is to understand something called as the functional currency and the presentation currency. Those two distinctions are very important for us to understand as to what is functional currency, what is presentation currency, and what is your transaction currency, or what is the reporting currency, and then what is the foreign currency. Now, generally what we have been understanding so far is that if, for example, my company is in India, then INR or rupee becomes my domestic currency, and let us say something like USD becomes my foreign currency. This was the understanding we had till we got introduced to India's 21. Now, India's 21, what it does is it brings in another concept called functional currency. So now we have three currencies: functional currency, presentation currency, and foreign currency. Okay, not really important from an examination point of view, but from understanding point of view it is very important. What is a functional currency, what is a presentation currency, and what is a foreign currency? Basically, presentation currency, if you have to understand, very simple, it is the currency in which you are required to prepare financial statements. For example, if you are based out of India, you have to prepare financial statements in INR for annual financial reporting purpose, for ROC filing purpose. For all of that, you prepare as per INR. So INR becomes your presentation currency, the currency in which we present the financial statement or prepare the financial statement, right? So this is the presentation currency. Now, what is the functional currency? Functional currency is different from presentation currency. Okay, sometimes functional and presentation may be same, but always it need not be the case. Now, what is the functional currency? Functional currency is the currency of what we say the primary economic environment. For example, if I take an example of, let us say, an Indian company, the Indian company functional presentation currency is INR. Now, can an Indian company have USD as the functional currency? Very much possible. If, for example, this company has majority, let us say 90% of operations based out of US. Majority purchases happen in US, majority customers are there in US, majority fundraisers in US. In that case, the functional currency can be US dollar. Okay, so the transaction, the presentation currency, the currency in which you prepare the financial statement, that is your currency in which you prepare the financial statement, whereas functional currency is the currency of what? Of primary economic environment. Primary economic environment meaning the economic environment in which the company basically operates. So a company may be registered in India, but business may be based out of a different country. In that case, the functional currency will be different, which is in our example US dollar. So then what is foreign currency? Foreign currency is any currency other than the functional currency. So GBP can be foreign currency. In fact, INR also can be a foreign currency for transaction accounting purpose, but will not complicate the thing. GBP, let's say, is the foreign currency. So you have the presentation currency, you have the functional currency, and you have the foreign currency. Now, what the standard says is all the transactions that you are recording, you will record in the functional currency. And even if it's a foreign currency transaction, even that transaction you will convert and you will record in the functional currency. Right. So let me just share the screen of notes. Just a moment. So what we have understood is the presentation currency is the currency in which the financial statements are presented. Functional currency is the currency of primary economic environment in which the entity operates. So whatever is the primary economic environment in which the entity operates, that is the functional currency. This will be given to you in the examination. And foreign currency is a currency other than the functional currency. So whatever is the currency other than the functional currency, that is called the foreign currency. Right. Now, how do we determine the functional currency? So we need to determine functional currency because all the transactions, they are recorded in functional currency only. Now how do we determine? There are certain primary indicators, there are certain secondary indicators and additional factors, right? Now what is the primary indicator? Something which influences my sales price. If dollar influences my sales price, then dollar can be the functional currency. If based on the competition and regulations, if you look at the competition, most of my competitors are based out of US, most of my competitive decisions are based on US dollars, then dollar can be functional currency. It influences my cost. I incur expenditure in dollars, so in that case also it becomes my functional currency. Then I raise funding in your US dollars, then dollar can become my functional currency. I'm using dollar just as an example so that you can relate it and write it in the examination. Then currency in which receipts are retained. If I collect from the customers and I retain all the receipts in, let us say, GBP, then GBP can be my functional currency. Now, it is not that just by looking at this one factor you can decide for sure. You have to look at all the parameters and see whether the particular currency is the currency of my primary economic environment. Okay, that is when you will decide whether it is a functional currency or not. Now, if the entity is a foreign operation, so if you are looking at a foreign operation, then in that case you have to see whether the functional currency of the foreign operation is same as that of the reporting entity. So you have, let us say, the entity and there is a foreign operation. Now the foreign operation may have a different functional currency, let us say pound. Okay, say pound. Entity may have dollar as the functional currency or rupee as the functional currency. Now you have to determine what should be the functional currency of the foreign operation. If the foreign operation is just an extension of the main entity, that is, it is like a branch fully dependent on the foreign, mainly dependent on the head office, subsidiary fully dependent on the parent, something what we understand as integral foreign operation kind of a scenario, where all the decisions, all the activities, the fundraising and all of that, it is decided by the head office or the entity. Then in that case it becomes an extension, and the functional currency of the reporting entity will be the functional currency of the foreign operation as well. If it is an autonomous, then you have to see the volume of transaction, degree of relationship, what is the cash flow that affects the debt servicing and all of those things, and based on these parameters you will decide whether the functional currency is the same or not. Now the reason why we need to know the functional currency of foreign operation is there will be a functional operation functional currency of foreign operation. Let us say this is pound. Presentation currency is, let us say, rupee. Functional currency of the entity is, let us say, dollar. So this foreign operation has to be converted to dollars, then this has to be converted into rupee, right? So that is where you need to decide, you need to understand what is the functional currency and what is the presentation currency. Now, we have understood the meaning of functional currency. Any currency other than the the functional currency is the foreign currency. And what is a foreign currency transaction? Now here we will be focusing on one is foreign currency transaction and the aspects related to foreign currency, your translation. Two aspects is what we need to understand. Now what is this foreign currency transaction? It is a transaction which is denominated or requires settlement in foreign currency. Means if I am, let us say, Infosys, and generally rule of thumb is the presentation currency generally is the reporting functional currency. So if Infosys, let us say rupee is the functional currency. Now if rupee is the functional currency, if Infosys exports in dollars, this dollar becomes a foreign currency transaction. The dollar export becomes a foreign currency transaction, right? Now it is a transaction which is denominated, means it is measured or it is indicated or it is, let's say invoice is issued in dollars, or it requires settlement in foreign currency. So either the transaction is denominated in dollars or the transaction has to be settled in dollars. In either case, it is your foreign currency. Okay. Now in case of foreign currency transaction, you can buy or sell goods or services in foreign currency, borrow money in foreign currency, acquire, dispose of asset, or settle the liabilities denominated of settle the liabilities in foreign currency, or you invoice in local currency but settlement is made in foreign currency. Means one leg of the transaction is foreign currency. So for example, sale is in rupee but settlement is in dollars. So here also it is a foreign currency transaction. Even if the settlement is in dollar, it is a foreign currency transaction. Now, how do we account for it? I will give you a very simple example of that, which will help you understand. So say in the same case, Infosys sells $1,000 and the USD INR exchange rate is 80. Okay. Now, if this is the transaction, what happens is, on the date of transaction, what the standard says is you have to record or you have to measure the transaction in what? In the functional currency. Now, if you have to measure the transaction in the functional currency, how will you measure? You have to decide what is the spot exchange rate. What is the spot exchange rate between USD and INR? So you have decided 80. So then what will you do? You will say debit account receivable 80,000, credit revenue 80,000. So initial measurement happens by using the spot exchange rate between the functional currency and the foreign currency on the date of transaction. Now sometimes you may use an average rate if it gives you similar results. If it is not materially different, you can use an average rate for the day, average rate for the week, or for the month. Okay. But if the exchange rate is fluctuating, then you cannot use the average rate. Right. Now, once you have done this initial measurement, let us say the customer, we sold these things on 1st of March, and on 31st March we have to prepare the financial statements. Now what the standard says is, if you have a monetary item, the monetary item is what? Items which have a fixed amount of monetary value or which can be converted into money in determined amounts. So monetary items are those items where the amount of money that you will get when you settle the transaction, when you settle the asset, when you sell the asset, or when you buy the settle the liability, that is known. Okay. So here account receivable is monetary item because the amount is fixed and determined. The monetary value is fixed and determined. Simple rule that you need to understand is all monetary items, what you need to do is you need to convert using closing rate. Which closing rate? On the date on which you are preparing the balance sheet or on the date of reporting. So if it is a monetary item, you will subsequently measure it using the closing rate. Meaning to say, if the same case $1,000 on 31st of March, USD INR exchange rate is, let us say, 81 and the transaction is not yet settled. So on the date of that particular settlement of the transaction, at the end of the reporting period, what will you do is you will say my account receivable is now 81 into $1,000, that is 81,000. Initially we recognized at how much? 80,000. Means we said our account receivable is 80,000. Now we are saying our account receivable is 81,000. There is an increase. This increase of 1,000 is called exchange gain. And this exchange gain is recognized in the then let us say subsequently on 30th of April we received $1,000 and on this day the exchange rate was 79. Now, as on 31st of March, we said we have to receive $81,000. We have to receive $81,000. How much did we receive? We received 79,000 rupees. Sorry, 81,000 rupees, 79,000 rupees. So we had to receive 81, we received 79. From here to here, there is a 2,000 loss. This loss is also recognized in P&L only. So here you will say debit account receivable 1,000, credit exchange gain 1,000. Here debit bank 79,000. My customer is gone, credit account receivable 81,000. The difference debit exchange loss 2,000. Right. So this is how you will account for monetary items. So what do we do with non-monetary items? If there is a non-monetary item, for example, you have purchased a PPE at $80,000 when the rate was 80. So 88s are 64, 0, 0, 1, 2, 3. You will continue to measure it at a cost of 64 lakhs only, you will not change. So if it is a non-monetary item, you will not change. But if let us say this PP I am using the revaluation model, and on the date of revaluation the dollar it became $85,000, then for the same date I have to take the rate, let us say at 82, and this will become the carrying amount or the value going forward as well. So if it is a monetary item, every balance sheet date you will take the closing rate and you will convert them. If it is a non-monetary item, you will take historical cost only, or if it is a fair value item, you will take the rate on fair valuation date. So on whichever date you did the fair valuation, on that date or of that date you will take the rate. Right? Any questions so far? Okay, no questions. So subsequently, if it is a monetary item, you will take the closing rate. If it's a non-monetary item, for historical cost basis, exchange rate on the date of transaction, means when did you originally purchase, fair value, the date on which fair value was arrived. So if you're following the cost model, if on the date of purchase 85, the value will be considered at that rate. If it is fair value model, then on the date of revaluation, whatever is the rate, you will change that rate and you will apply it accordingly. What are monetary items? Units of currency held and assets and liabilities to be received or paid in fixed or determinable number of units of currency. Means you know what is the amount to be received or paid. All your liabilities, current liabilities, trade payables, loan, your current assets like account receivable, wherever you know what is the amount to be paid, those are called your monetary items. Non-monetary item means there is no fixed or determinable number of units of currency. Meaning to say, you don't know how much will you get. For example, inventory. Now, when you talk about inventory, you do not know what is the value of inventory. You will realize when you sell the inventory. Same way, fixed assets, equity, investments in shares, etc. Right? So that is the between monetary and non-monetary item. If there is a monetary item and there is a foreign exchange gain or loss, you will account for it in P&L directly. Exception, Ind AS 109, if there is paragraph 46A applicability as per AS 11, under AS 11 you will do that, and in case of non-integral foreign operations. Okay. Whereas if there is a foreign exchange gain or loss on non-monetary item, for example, investment in equity shares or something like that, then wherever you recognize the gain or loss on non-monetary item, you will recognize the, the same thing in case of the foreign exchange gain or loss as well. For example, if you have investment in shares, now this investment in shares as per Ind AS 109, you will recognize in OCI. Then here also you will recognize the exchange difference in OCI. Otherwise, you will account for exchange difference in the P&L. Now, one thing what you have understood is if there is a, let us say, a loan. Okay, let us say we have taken $10,000 loan to acquire PPE. Okay, $10,000 loan to acquire PPE. The rate is 80. So the value of PPE is 800 or loan is 800,000. Now subsequently what happened is, let us say on 31st of March, the value became 85. So 10,000 into 85, now you have to pay 8,50,000. So 50,000 is the loss. As per Ind AS and as per IAS also, you have to recognize this loss where in the P&L. Now during the 2008, 9, 10 time, when there was a lot of volatility in the market, when Lehman Brothers collapsed and all of that, exchange rate fluctuation was very heavy, and we should took all of this amount as loss in the P&L. Balance sheets or the P&L was looking really bad. So what the government did was they introduced paragraph 46 and 46A as per AS 11, under AS 11, where they said this 50,000 of loss which is on a monetary item for acquisition of a long-term asset, then in that case this loss, whatever is 50,000, instead of debiting this to P&L, don't debit to P&L, you can debit to PPE. Basically, the foreign exchange loss can be added to the cost of PPE. That is the treatment that is allowed under paragraph 46A. Okay. Now, IAS does not have similar provision, and what Ind AS 1011 has done is they have allowed an entity to choose on an optional basis that whatever is the exchange gain or loss, whatever is the exchange gain or loss which is on a long-term monetary item, if it is used to acquire a depreciable asset, then you can add the foreign exchange gain or loss to the depreciable asset. For example, let us say in our case 1 lakh loan and exchange rate is 80, closing rate is 85. What example just now we took. Okay. Now here long-term loan initially was 80 lakhs. Now the long-term loan has become 85 lakhs. This 5 lakhs of loss can be added to the cost of PPE. Please understand, we are not measuring or remeasuring PPE. PPE is a non-monetary item. This will be carried at historical cost only. Just that the loss here can be added to the PPE. So exchange difference on foreign currency long-term monetary item, if it is in case of a depreciable asset, you can add or deduct from the carrying amount. If it is for non-depreciable asset, something like land, you can transfer it to foreign currency monetary item translation difference account, that is FCMITTA. How to remember this? Foreign currency monetary item translation difference account, and amortize it over the remaining life. Now if it's something like land which is non-depreciable, so you will amortize it over the remaining life of the liability. Okay, so this is an exception, optional exception, where Ind AS 101 allows an entity to continue to apply paragraph 46A. Any questions so far? For CMA final, see, if it is, I'm doing a pretty fast track basis of classes. If these these standards are covered to whatever extent, 1.5 hour, it will help you actually understand how to handle these transactions. It will actually be useful to you only. Okay. So two aspects we have understood. One, foreign currency transaction, how to account for it. Second, exchange difference for monetary items. And here paragraph 46A, if the entity chooses, they can continue to apply. Okay, now the next important aspect that we need to understand is translation of financial statement. Now, what is translation? See, transaction is one-to-one transaction. Entity sold goods to customer. It is a transaction. Translation. What is translation? Translation is basically, for example, let us say you have Amazon US and you have Amazon India. Amazon US prepares its financial statement in USD terms. Amazon India presents its financial statement in INR terms. In INR terms. Okay. Now, USD is the functional currency of Amazon US. Here it is INR is the functional currency, for example. Now, Amazon US will prepare its financial statement independently in US dollars. Amazon India will present its financial statement independently in INR. Right. Now, what happens is Amazon US also has to prepare consolidated financial statement. For that, you cannot add USD and INR balance sheet. You have to convert these balance sheets of P&L. Just a moment. Yeah. So you what have to do is you have to convert this INR into USD. So all the financial statement, your P&L balance sheet, you have to convert from INR to USD so that they can be consolidated properly. Now, what is a transaction? Transaction is if Amazon US, let us say, sells goods to Amazon India or to any other foreign party. That is a accounting for foreign currency transaction. Where on a transaction to transaction basis you do conversion. Whereas when it comes to translation, what happens? Translation means you are taking the entire financial statements of a branch, of a subsidiary, of a joint venture, and you are converting them. Okay, that is called translation. So, a foreign operation is a subsidiary, associate, joint venture, branch of the reporting entity, activity of which are based or conducted in a country currency other than those of the reporting entity. So, very simple. It's a foreign operation. It's a foreign branch. It's a foreign subsidiary. It's a foreign joint venture. Now, the way the translation works is the foreign currency, foreign operations, whatever you have, you will convert them into functional currency of the parent company, which will be again converted into presentation currency. In most of the cases, let us say functional currency is INR, presentation is also INR, this translation is not needed. Otherwise, you will take this currency, let us say US branch to INR in India and subsequent to the presentation currency. Right. Now, when you do this translation, again, the rate of thing is monetary items closing rate and the non-monetary item historical rate, right? Now, when it comes to translation to presentation currency, all assets and liabilities closing rate, profit and loss items individual rate or average rate on the transaction date, equity historical rate. So we'll take in the next class we'll take a couple of examples and see how this translation happens. All resulting difference that are arising due to this translation is recognized in other comprehensive income, that is called FCTR, foreign currency translation reserve. Foreign currency translation reserve, and accordingly you will accumulate this in OCI and carry it till the time it is not disposed of. Means till the time you are continuing to operate the foreign operation, you will carry the difference in foreign currency translation reserve. Now, whenever there is an head office or a parent and there is an investment in foreign operation, we also have something called as net investment in a foreign operation. Okay, net investment in a foreign operation, that is the amount of reporting entities interest in the net assets of the operation, the amount of reporting entities interest as a part of the particular operation. So whatever is the share of this entity in the foreign operation, what is the share in net assets? What is the share in net assets? That is called net investment in foreign operation. Now, if there is any monetary item for which settlement is neither planned nor likely to occur in the foreseeable future, that is a long-term monetary item, that is a part of the entity's net investment in foreign operation. So, just to give you an example, trade receivable and trade payable, these are short-term. These will not be a part of NIFO, whereas long-term loans and receivables and payables which are given will be a part of NIFO, that is net investment in foreign operation. Now, how do we account for foreign exchange gain or loss on monetary items? So this basically, head office has made investment in foreign operation. So you have investment in foreign operation. Plus, if there is something which is receivable minus something which is payable, this basically represents the net investment. This is on a long-term basis. Okay, so all the investment made by the entity in its foreign operation will form part of this one. Right now, if the monetary item forms part of NIFO, that is net investment in foreign operation, then what happens? Then in that case, you will report in the combined financial statement as other comprehensive income. In individual statement, you will report to P&L. Please understand, if there is a monetary item which forms part of NIFO, in the individual financial statement, what will you do? In the individual financial statement, you will always show this monetary item gain or loss in P&L. Whereas in the combined financial statement, you will take the difference to other comprehensive income. If the monetary item is not part of NIFO, then anyways you take it to P&L. So here what are we saying? That the reporting entity has made certain investments in the other entity and we are doing that consolidation. Then in that case, for monetary item which forms part of NIFO, then you take it to OCI. In other cases, you take it to P&L. Then there are certain intra-group transactions. Now all intra-group transactions in the consolidated financial statements we have to eliminate. So any intra-group balances, eliminate. Any unrealized gain, eliminate. Exchange gain or loss recognized in standalone statement, you will continue to recognize in consolidated financial statement. Then again, if there is an exchange gain or loss on monetary item forming part of NIFO, you will take it to OCI. Not forming part of NIFO, you will take it to consolidated P&L. For example, here USD rate is 50, closing rate is 55. Holding company has given a loan to the subsidiary. Amount is 1 lakh in INR. So subsidiary company will say I have received 2000 of loan. Then loan at the year end, loan will be 1 lakh. When you restate it, it becomes 1818. So there is this exchange gain of 181.12. Now this 181.9212 will be taken to OCI in the consolidated financial statement. Then another example, holding company sold goods to subsidiary worth $1,000. Profit element is 10,000. Inventory is not yet sold and transaction not yet settled by the subsidiary. So $1,000 of goods, profit element on sale is 10,000. Holding sold to subsidiary. Inventory is also not sold, transaction is also not settled. Then what happens? See, when you sell that, when you make the sale, you will say account receivable to sales 80,000, 80,000. At the year end, you will say account receivable to exchange gain 5,000, 5,000. Right now. Profit on sale, whatever is recognized, this 10,000 here, this 10,000 has to be eliminated. From where? It has to be eliminated from your, what do you call, the inventory, because subsidiary will account for it as inventory at 80,000, right? So that profit element, whatever is there, that 80,000 or 10,000 of profit element, that is removed. So you will eliminate the profit by reducing the value of inventory. Then exchange gain on account receivable. There is an exchange gain on account receivable. What is the exchange gain on account receivable? It became from $1,000, it has become 85. So 80 has become 85. So you have 5,000 of gain. It has become 5,000 of gain, right? Now that gain will also be set off from exchange gain on inventory. So finally, ultimately, you will value the inventory at cost. Then, if there is a disposal of foreign operation of a subsidiary which is not wholly owned, that is a partially owned subsidiary, then the exchange difference under foreign currency translation reserve is transferred to OCI up to the percentage owned by holding company, remaining will be transferred to NCI. So, if it is a partly owned subsidiary, let us say 80% and 20%, and if you are disposing of the subsidiary, whatever is the balance in FCTR, 80% will be taken to OCI and 20% will be taken to NCI. This is the other comprehensive income, this is the non-controlling interest. Then FCTR recognized under OCI will be carried out till the time of disposal of the subsidiary. So you will continue to carry out till the time of disposal of subsidiary. If it is fully disposed, entire portion of FCTR will be taken to PNL. If it is partial disposal, then you will move it from OCI to PNL proportionate portion. And if there is no loss of control, you will move from OCI to NCI. Okay, so this is the theoretical aspect that is relevant for our discussion purpose. In tomorrow's class, we will take up a couple of questions and discuss in detail how do we do translation and how do we do the disposal related aspects in case of foreign currency transactions. Monetary item, non-monetary item, how to identify the difference? Monetary item, amount is fixed. Customer, I have to receive 1,000, amount is fixed. Supplier, I have to pay 1,000, amount is fixed. Fixed asset, if you look at, amount that I will realize is not fixed. So, it is a non-monetary